Coming to our income tax class. Now we are going to discuss about how to calculate the values in house property. That means how to calculate the income of a house property. See, in the previous sessions, I told you what is called house property income. First of all, what is a house property? How the income should be considered for the house property. Now, the format what you are seeing in the board, that will gives you the clear idea about how the income is calculated in house property. See, basically we should understand one important point. Though the rental value is considered for, it is the important item for the computation of house property, but that alone is not taken as income of the house property. Why? Because the value of the property is based on various things. It is fetched with, it is related to municipal value, standard rent, fair rental value and actual rent received. So, how to calculate house property income is the important item we should know. This format, I hope this format will help you how to calculate the income. See, we have to take fair rental value and municipal value, that both the items should be compared and whichever is higher should be taken. Fair rental value is 40,000, municipal value is 50,000, then 50,000 should be taken. So, in that way, these two items should be compared and higher value should not be more than the next one standard rent. So, what is the meaning for that? The compared values should not be more than standard rent. Why? Because standard rent is the rent fixed based on the Rent Control Act. So, what the value you are calculating should not be more than the rent as per the Act. Rent calculated based on Rent Control Act. So, the compared value should not in excess of standard rent. That means whichever is lesser, lower, that should be considered. Then that value is taken as expected rent. So, fair rental value and municipal value, whichever is higher, that should be compared with the standard rent, whichever is lower, it is named as expected rental value. That ERV, that is expected rental value, in short it is denoted as ERV. That ERV should be compared with what the actual rent you are getting. So, from the property, if I am getting 60,000 rupees for a year as the rent value I am getting, then these two things should be compared. Higher value is taken as GAV, that means gross annual value. From gross annual value, municipal tax should be deducted. Please mind it, municipal tax is the actual amount of tax paid to the local authorities. I am residing in Chennai, so what the amount of municipal tax I am paying to the Madras Corporation. So, like that, municipal tax what we are paying, that amount is eligible to deduct it from the gross annual value. Balance is net annual value. And as far as that municipal tax is concerned, you should also note it down that amount is actually paid, and that amount is paid by the owner of the property. See, basically you are all well aware that for determining the income from the house property, the assessee should be the owner of the property, or at least he should be the deemed owner of the property. So, what the amount of municipal tax is paid by the owner of the property, that one is taken as deduction and balance is called as net annual value. From the net annual value, you are eligible to deduct two items under section 24. First one, which is called standard deduction. Please understand very clearly, standard deduction is the term we are using it in different circumstances. In what is that? In salary income, we use the term standard deduction, 50,000 rupees for all the assessees. And deduction we are going to use under 80 series, right? Whereas here under section 24 we are going to have deduction, standard deduction. It is calculated 30% on NAV, 30% on net annual value. If your net annual value is supposed to be, if your net annual value, for example to say, is 1 lakh rupees, then your standard deduction, eligible standard deduction is 30,000 rupees. So what the net annual value you are having, on that you have to calculate the standard deduction. It is 30%. Then another one item which is called interest on loan, and this is also important point. Interest on loan borrowed for the construction of this property. Interest on loan, it is for borrowed for the construction of the property, for the alteration of the property, for the renovation of the property, and it is taken in two ways. Two categories we are having in interest on loan. One is called pre-construction interest. Another one is post-construction interest. Before the construction of the property, see, basically you are all well aware that once the property is constructed, after that, after the completion of the construction only, we can able to derive the income, that is we can let out the property. But if you borrowed the loan for the purchase of the property and construction of the property, from that date onwards your interest will be calculated, your interest on that loan, that will be calculated. So two things we should keep in mind, pre-construction interest and post-construction interest. Anyhow, we will have a separate class for the amount eligible for self-occupied property and let out property, pre-construction, post-construction, all those things will be discussed separately. Now you keep in mind, interest on loan borrowed for this property, construction, repair, renovation, etc., that amount is eligible. So net annual value minus the deductions which are standard deduction and interest on loan, both the items can be deducted. Balance is supposed to be your income or the loss on the house property. Please mind it carefully. Income or loss on the house property should be calculated, should be determined for individual property. If I am having two properties, both the items should be calculated separately. If I am having 5 properties, or one property, 5 separate units I am having, all 5 units are let out, I am deriving the benefit, should be calculated separately. So likewise, based on this statement, based on this format, we have to calculate the values of the house property.